Good morning, everyone. We're pleased that you could join us today for NowVertical's first quarter 2022 webinar. I'm Glenn Nelson, Vice President of Investor Relations and Communications here at Now. And with us today, we have Daren Trousdell, Chairman and CEO of NowVertical Group. Just to give you an idea of the format today, the webinar will begin with some opening comments from Daren on the recent company developments and on the results we posted last night. After those prepared comments, we'll take some questions from the investment community. For those of you not familiar with the Zoom webinar function, there is a Q&A button at the bottom of your screens. Anytime during the presentation, you can type in your question and we'll try and get through them at the end of this. Please note, a replay of the webinar will be available on our website at ir.nowvertical.com following the presentation later today. I'd also like to remind you that the remarks we're making may include forward-looking statements and are subject to important risks and uncertainties. For more information on those, you can check out the filings we've done on SEDAR last night. And lastly, I'd also like to point out that during this presentation, we will be referring to some non-GAAP or non-IFRS measures, such as adjusted revenue, pro forma TTM revenue, adjusted revenue, and the like. Those measures don't have any standardized meaning under IFRS, and as a result, they may not be comparable to measures presented by other entities. With that, I'll turn the presentation over to Daren. Thanks, Daren.
Thank you, and thanks everyone for joining today. So we put out our quarterly results yesterday. We're very happy about them, and today I'm just going to kind of share how we got to this point in our growth. In the last 19 months, we've taken a company from zero to pro forma TTM adjusted revenue of 30 million. So incredible growth. We've built a company from 2 people, myself and our head of corporate development, Andre Garber, to over 300 people in multiple countries, 8 acquisitions across both 2021 and 2022, being the lion's share of our acquisition activity, and bringing our strategy to life. So I'm very, very proud of our team. I'm proud of our shareholder partners. I'm proud of our customers. I'm proud of our sales channel partners as well, helping us get to this point. So it's kind of feels like a significant turning point for our company, where we're starting to get a lot of our growth reflected in the financials. I think you'll see moving forward into the next filing another substantial leap forward in our financial reporting, because we're able to have our acquisitions online in a full reporting period basis, which we haven't had up until now. So it's a wonderful kind of thing to see this in action and play out. We have excellent momentum, which is kind of an interesting thing to have when you're in a tough marketplace. The capital markets have not been friendly for some time to small caps. They're not friendly to large caps, and they're not friendly to tech. So there's a lot of themes that have been creating some general headwinds for everybody in the market. However, we've stayed determined and have made some significant investments in areas that are going to be substantive to our growth moving forward. It's illustrative in our growth as well, just on a non-pro forma basis, not factoring in the very accretive acquisitions we've done. It's a 260% growth from the comparative period in 21. And on a gross profit basis, we're growing that substantially. And it's a very important metric for our business. Our software gross profit metrics are strong, 70% plus. Our solutions group gross margins, we're optimizing to stay, equally as strong and, outperform the general market. I think a strong gross margin profile sets the stage for what's really coming with our story, which is clear path to profitability and a future free cash flow profile in this consolidation method is really what we're focused on here, is to continue to acquire assets that we can have contribution margin that will ultimately start to create reinvestable cash at the top company level, and that we're staying laser focused on that in any kind of market context. I think kind of highlighting the momentum of the way I look at the business, and I would hope you would look at the business now and moving forward. Our Q1 adjusted pro forma revenue is 7.5 million, including all of our assets. So that's substantial growth again from 18 months ago. We're really setting the stage for our run rate, which we're targeting at the end of the year to be around 40. Even from a TTM 30 basis, that's 25% growth. We want to stay in that kind of range on our organic assets. And when we add new assets to the mix, we want those assets to meet a minimum growth, growth percentage and a growth rate, sorry. And we think that's a healthy growth rate for our group. Kind of looking at it this way, we see through the rest of the year, all of this coming online with the existing assets we have. So it's not just an inorganic story that we're telling, it's an organic, inorganic story. We're going to stay very acquisitive. We're going to be in the market looking for opportunities. The market is in a really interesting inflection point because there's going to be, and there already has been, an influx of new M&A opportunities for us. And on the tech side, software side, it's starting to flow in a much, much bigger way than previously at much more reasonable valuations because of the market compression in the private sector too. Now it's starting to come online in the private sector. So we want to be in a position to take advantage of these, pricing exercises ultimately and bring that into our world and get that benefit. So we're hoping to see our currency continue to improve in value, come back to health, and then get to where it needs to be on value, because that currency is the cheapest cost of capital, in our opinion, in our acquisitions. And we want to stay very, very focused on that. So, markets have made an impact to everybody. Our plan from inception has been to build enough revenue scale in our group that we could matter to a global investor base and create enough scale to get into the capital markets context with our comparable set in the US that we go up against in the commercial space. And we believe 100 million top line is that number. So for us, we're staying focused on that. It's not easy in a tight kind of capital markets, but we've now started a lot of work that I think was clear in some of our previous press releases, like our Allegiant acquisition. We highlighted that part of that acquisition was financed, or consideration was financed through debt with our partner MVB Bank. We have a lot of work happening on the debt side of the house, meaning finding cheaper costs of capital to complete our acquisition program. So we're going to stay acquisitive regardless of market conditions, and we feel we have the support to do that. So we're going to keep kind of moving on strategy to get to our target of this 100 million top line. And we should all be very proud, given we're almost halfway there on on a business that, again, just started 18 months ago, had around $16 million of invested capital net of fees. It's truly remarkable in my opinion. So we're going to stay on the course. We're going to continue to execute as we have. We're going to continue to create value for our shareholders and bring this to plan. And that's what we're going to do, and we have done. So I want to thank everyone for their contribution to this point. I think the quarter was excellent. The team that we have is second to none. We're in a great position. A lot of integration work has been done on the company side, bringing our first set of 8 into an integrated state. And then now we have to add more contributors to the mix to get through our plan. So that's really it. So Glenn, I'll pass it back to you for a couple questions.
Great, thank you, Daren. So I'd like to remind everybody viewing today that you can answer or ask questions by clicking on the Q&A button at the bottom of the screen here. I'll give you a minute to do that. But we can start off. Here's a question from Rob Goff. Can you, from Echelon Partners, sorry. Can you discuss the organic growth you're seeing and where you're seeing cross-selling leveraging at the moment?
Yeah, so total group organic growth for 21 to 22 will, like I said, be about a 25 to 30% growth rate. So that's what we're working against, and driving that actually is the independent businesses growing themselves. We have not factored into our plan for this year any substantial cross-selling activities when we think of the forecast business. What we're seeing though is a large demand coming from our solutions groups, moving our software products into their customers. In our Latin American business, we have a financial customer, as an example, that is now looking at our Reveal product and data discovery to bring into their organization, and that would be a full, integrated cross-sell opportunity, and that we're really excited about. In our government business, we've executed a variety of proofs of concepts and lots of work on our products, and we're starting to get some wins with our GovCon business, bringing the software products into their world as well, both through Allegiant and through our existing government business, including, interesting enough, in the federal law enforcement space, we are starting a project with Affinia. So it's not just, the more significant complex tech that's working. It's even the easier to integrate products like Affinia on a SaaS basis that are creating demand. So we have a lot of activity happening there, but we're really not looking for that growth to be factored in until next year. We see significant growth there. We're hoping, that we can use this cross-selling growth to, improve our year for this year. But, that's how we're looking at it.
Okay, and just a follow up there. Can you give us a feel for the growth in your order backlog and your RFP pipeline?
Yeah, so the backlog right now, kind of generally on contractor revenues north of 70 million. That's going to be increasing. Right now, we have a lot of new business activity on the total backlog for the group, especially in GovCon. So I could see this backlog definitely cresting 100 million by the end of the year.
Great. And can you discuss a profile of the companies within the $60 million pipeline that you've kind of identified, growth, profitability, and valuation parameters?
The ones we're focusing on and working to close right now are all going to be solving global positioning. So we want to get enough global coverage. So we have, right now, strong in Latin America, strong in the US. We want to be stronger in the US. So we want to add more US assets. Strong in Canada, strong in the UK. We need other European destinations, and we need other markets like Asia or Australasia to give our global customers somewhat of a fulsome picture of available tooling and expertise to cover different markets. So that's what we're working on. In terms of their profile, the companies we're focused on now, all cash flow positive companies, all companies that are immediately accretive, relatively basic in integration into our network, which is key right now. So we're not adding any additional costs to integrate and manage, and we'll be immediately accretive on the customer opportunity, meaning they're going to be selling in our other software products the same way Core BI and Allegiant are.
Great, thank you. This next question is from Gary DeStefano. Daren, congratulations on the very impressive Q1. How has your methodology changed, if at all, for potential acquisitions looking forward? I think we've addressed some of that, but given the state of the market is where it's at today.
Yeah, we have to change our approach in deal structure, financing these transactions. There's going to be, it's a path to finding the cheapest cost of capital to make these deals as accretive as we can make them. So, traditional acquisition lines, debt lines, forces us to make sure these transactions can support that as well. So in our overall M&A pipeline, we've had to prioritize the companies that can sustain servicing, or contributing and servicing our debt, and being strong enough contributors to also have cash come up to the group co beyond debt.
Perfect. And so this next question is from Hernan Gomez. Regarding further acquisitions for this year, will you be focusing on acquiring software IP, or will you be acquiring more service companies?
Just given the last point, we are focused on building out the solutions network right now. We have some great tech assets that are transacting through our services network. We want to have more. We're going to get in a position through summer into the rest of the year next year where there's a lot of great tech assets that are going to be sold for extreme value. So I think right now in the short term, next quarter, 2 quarters out, we want to get our services and solutions network built out globally. So another couple, 2, 3 acquisitions done that are going to provide that network, but also contribution margin I mentioned. Then I think we'll start looking at some additional tech opportunities when the prices are right.
Can you please, this is from Reza, an investor, can you please give us the difference between the 40 million that you're projecting in run rate and the 100 million projection?
Yes, so the 40 million that we're looking at for our year is our current asset base with the growth that we expect from that current asset base. The 100 million will include net new acquisitions. So if we cannot do net new acquisitions due to market conditions, or we can't negotiate accretive transactions, what have you, we will not get to our $100 million number. So we've had this goal because it, again, is very prescriptive for what our strategy is to move the story into the US markets effectively. Do we have to be there? No, it's just where we want to be in our belief in the kind of capital market strategy for our future. 40 million on our current asset base is a phenomenal achievement. And if we can keep growing at the rates we are, we see that, becoming over time, a couple of years of this is a substantial business on its own, without having to do anything. So we're in a fortunate position that we have a great existing business that is setting the stage for an incredible, profitable future. Acquisitions being truly accretive now, that's how we are kind of blending the mix.
Right. And I think maybe the last question here, Daren. We have from Andre Bodo at Echelon Partners. He's asking kind of a follow-on to the Affinio comments you were making there. How should we view Affinio's gross margin profile over 22 and kind of that margin expansion in that segment?
Yeah, I think Affinio is an interesting business for us because, as a tech asset, they come in with, they come in with 2 distinct products, one mature, one that has become a very important product to the, media entertainment industry, and, pre-acquisition, a significant investment in a brand new product, which is our Snowflake privacy first data set. And that future Snowflake product is really powerful and has a lot of opportunity for customers, ourselves, and our partner base. But the existing Affinio organic business, we are going to focus our energy and investment there to grow right now, because we, through the last few months, have done a lot of work on that business, and there's a great margin opportunity there. So through the rest of 22, we see growth happening in our Affinio, we call it Affinio Classic, our classic Affinio business, on our graph analytics product, and expanding the customers we have. And the new opportunity I see in the Affinio business is adding our services opportunities to it, because we're just selling a SaaS-based product there. We are not doing much in terms of managed services or creating any consultative opportunities with those customers. And again, these are some of the world's best customers. On the media side, you have major media companies that we all use and know. And then on the brand side, lots of CPG customers, Danone. On the retail side, Ralph Lauren, and so on and so forth. So there's a ton of opportunity in the Affinio business, and we have to materialize it now.
Okay, so we have one more question from Michael Palmer at PI Financial. His question is regarding the Allegiant acquisition, and have you seen growth in the government business backlog? And what would you like to see on that side of the business by year end?
Yeah, so we are seeing growth in the government backlog with Allegiant. You know, when we announced the acquisition, it was sub 70 million. It's over 70 million now, and we have a significant new business program. Allegiant has with Angels, the president and his team, the Devon Patel, there's an incredible new business engine there that our solutions group president is also contributing, Dave Whitmire, and I think we see that becoming significant. As I said earlier in the webinar, that backlog could be north of 100 million itself very, very soon.
Thank you. Well, thank you very much, Daren. I think that's the end of the questions today. If anyone wants to follow up with Daren or myself, please feel to reach out directly. You can find our contact at the back of this presentation, which will be posted on the website after this webinar concludes, as well as a replay. So feel free, and thank you very much for joining us today. Thank you, Daren.
Thanks everyone for your time. And I think parting words from me, I think we've crossed kind of an inflection point here, getting into our Q2 reporting. I think we're in a really great position to take our story to where it should be, both on value and opportunity. So thank you so much for all your great questions, your support, and we look forward to seeing you again soon.
Thank you.